All right, Eel Nerds, episode 167, and this one is a crazy one because the times are crazy. There is a party of all kinds of black swans in front of the New York Stock Exchange. Our Treasury Secretary, Mr. Besant, has fired a $10 billion bazooka, and I am making 30% returns on my stock. How about all of that for 1 week? We're up to 472 subscribers. Thank you for your support. There are a few playlists. If you don't know which one to start, I would suggest you use the roadmap, which goes through the show in chronological order. Most importantly, please remember I have no magical powers. Check anything you see here and do your own homework. Well, what do we have today? That is me feeding the black swans in front of the stock exchange. We'll take a look at the market temperature and I will do a little cheer for my equity returns that have been absolutely stellar. And we'll look at the Black Swan Party, Chairman Besant's, sorry, not Chairman Besant, Secretary Besant's 10 billion bazooka, and how I am positioning based on that. My entire portfolio, for those of you who have followed me along, I'm a steady Eddie trader. I don't do anything rash. My portfolio returns about 5.5%, something like that in the last year. And most of it is state tax exempt. A good chunk of it is becoming federal tax exempt. So I'm working through how to get there. I do have an equity portfolio. My equity portfolio overall has returned a cool 23% in the last year, but even that 23% is understated because I have some treasuries inside my equity portfolio. And if you were to remove all of those and only look at pure equities, I will show you my cool returns, and I'm very excited to see that. Obviously, I'm getting a big head. I'm thinking somehow I am better. I can party with the black swans because I am increasing my equity portfolio while making these returns. And so I will tell you how I'm doing it, how I'm thinking through, and I am looking for your advice as well. Please share and continue that. Well, as I told you, if you only looked at stocks and if you removed the treasuries I have in my equity portfolio, then my small company returns are 32% for the last year, or for the last 3 months rather, and year to date 7.5%. These smash any and all indices that are there. This is from the Schwab Portfolio Performance Asset Class Performance Report, a very interesting report. Take a peek for your own portfolio if you have not already. And that is one that tells me that the filters I'm using are working. I'll review what they are. And then I looked at treasuries and it said I make 1% on treasuries. And I said, wait a second, you can't even make 1% on treasuries if you tried. How is that happening? I called Schwab customer support and they said, oh, do you own treasury bills? And I said, yes, and a bunch of them. They said, the gains of the treasury bill, the difference between the amount you bought, $98, par value, $100, is not included in your return. And I said, excuse me? And they said, we know, this isn't the correct way of reporting fixed income. So there is Schwab for you. But anyway, my treasuries return a healthy amount as well. That is why my overall portfolio shows 5.5%, with my small companies returning 32%. So it's working well for me. You do you. What I then did is said, I know as I keep buying equities and feeding these black swans, let me share how I think. And before I go too far, I want to make sure you know that I'm not a wealth management advisor. This is not investment advice or tax advice. I don't do politics and I don't pitch product. So make sure that you do your own verification. Well, my 32% small business, small company equity returns are powered by two very simple rules. I open a very small position. You may open it with one single stock. You may open with 100 stocks, whatever it is. I open a small position on day one and I use one of the two filters. I either use the value filter or the growth filter. And I'll tell you what they are. If the stock falls, then I buy 10% more. If the stock gains, I see if it gains for 2 or 3 consecutive days, and if it does, then I buy another 10%. So I'm following my instinct. Once it meets these filters, I then turn around and buy if it falls, And then if it continues growing, I buy again. If the fundamentals change, and if I ended up owning something and it appreciated by 50%, but the company basically hasn't changed, then I'm going to consider it overvalued. I sell it. Otherwise, I just hold on to it. If the company stock price goes down, I don't panic and sell. I wait and see if the fundamentals changed again. And if they did, I would sell. Otherwise, I hold on to it. That is it. Very simple. Let me review what my value filter is. It's pretty simple. I only buy domestic stock. I look for high volume because if I need to sell, I want to make sure there is someone there to buy it. Low PE ratio, very little debt, a very healthy profit margin, a very low price to cash flow. So the company needs to keep pumping cash. And the rest of the indices are derivatives of the others: return on invested capital, return on equity, return on assets. But I also want a strong growth rate, and I need it to be widely held, not closely held. That is it. If it meets this value filter, I then do research on each of those companies and see if they are aligned macroeconomically, and I start buying them. What about my growth filter? My growth filter momentarily ignores profit. So it just goes after growth. It says if you don't have a lot of debt and you're widely traded, show me companies that are growing at more than 15% in the last 3 years and growing at more than 15% in the trailing 12 months and are expected to grow at more than 15%. And I just look at those and then I research the macroeconomic alignment and put it through my workflow. The result, I am now diversified across all sectors. There are a couple of sectors where I'm overweight. Consumer staples, and I'll tell you why I'm overweight in these, what you would call defensive sectors. I'm overweight in consumer staples, I'm overweight in healthcare, and overweight in utilities. These are the defensive sectors. There is a cyclical sector, which is energy. Right now, I happen to believe the price to book ratio on energy stocks is way too low. I actually own a certain company, and this is not an endorsement for you, it's an explanation for me. There is a company called Noble Corporation. It trades at a price to book less than one, which means you can buy Noble Corporation, sell all of their assets, pay off their debt, and you will have change left over. That's bonkers. And so I own companies like that. So here are some stars. This is from 24 hours ago, and today has been an even better day. So I have things ranging from 50, 30, 40% above what I paid for it. I do have some dogs at the very, very bottom, but my allocations are small because I follow my whole idea of starting small and adding a little and adding more. I will show you every one of these stocks I own. This is just the top 5% and the bottom 5%. But let me get to the crux of today, which is the black swan party. Why do I believe there is a black swan party going on? Because there is indeed several risk factors for the economy. The first is the Russian response to Ukraine's recent military advances. And if Russia goes wild in their response and mainland Europe joins, we will have a lot of turmoil in the market. If there is a tariff war that goes beyond the base case, maybe the 30% tariffs are here to stay, maybe 50% tariffs are here to stay, and maybe it happens faster than we think it will. The market generally thinks that is not going to happen, but if it does, we're in for a rude awakening. Stagflation is another black swan. We recently saw unemployment is going up, inflation is higher than 2%, and when both of those come and GDP does not grow, if GDP contracts, then we got the perfect stagflation, which is terrible but might happen, another black swan. There is a debt ceiling X date that is coming. I don't really think we're going to default. Never happened before. Politicians are too smart. They don't want to blame. So that is not going to happen. However, there is a need for $9 trillion of treasuries to be refinanced. And if that happens too far, too fast, then long-term yields will spike and I will gobble them up. At least I think so. And these are all the black swans that can happen in the next 30, 45 days. So it's not exactly the season to go celebrate and buy equities. And Mr. Besant just brought a 10 billion bazooka to the party. What do I mean by that? Well, we have a treasury, and the treasury says, well, the Fed Open Market Committee is not decreasing rates, so we're just going to print money. So what did Mr. Besant do? Mr. Besant said, go ahead and print $10 billion. We will buy our own debt with that money. Now, what does that do? If the original discount, and I'm using simple numbers, if the original discount was going to be $99, that appreciates to be $100. And Mr. Besant said, here is a whole bunch of new buyers. Then in an auction, instead of discounting all the way to $99 to fill the pot, you may only discount to 99.5. So in that scenario, the difference between the discounted value and 100 is smaller, which means interest rates will decrease. So Mr. Besant bought a whole bunch of treasuries that mature in 2025, 2026, and 2027. So this, in my opinion, is a test drive of how it works in the short end of the curve. And if the Fed does not drop interest rates down, this is almost like a warning shot. Hey, drop interest rates, and if you don't, I'm going to go do this to the long end. If Mr. Besant does that, then we will indeed potentially have a bear steepening if there is too much that comes in that end. Or if Mr. Besant has his cake and eats it too, long-term interest rates will also drop. Either way, the idea is to get the FOMC to drop interest rates or get the Treasury to force more money in there to decrease interest rates. To me, that's a signal to increase duration smartly. And that is what I have been doing. Let me explain more. My allocations, none of this is a surprise to you, except there is a trend. My treasury holding used to be 80%. It is now down to 68%. My agencies are steady at 10. My investment grade corporate bonds are mostly COVID duds, which will go away. My investment grade munis went from 0 to 8% in the last 4 weeks. So I've been accumulating investment grade munis dime a dozen, and that is where I've been focusing most of my time. However, if you look at my credit rating, you will see that aside from a small allocation of duds that I bought during COVID, and those are also going to mature and get off my books, everything I own is investment grade. And that is mainly because I only buy investment grade munis or I buy treasuries. This not rated is really T-bills. So my hope is that because I perceive and the world perceives we will not default on our debt, by holding T-bills, by holding treasuries and munis, my quality of debt is very high and my duration is where the magic is happening, or at least I'm hoping to make it happen. Number one, I am increasing duration for all the reasons I described and discussed earlier. The 5, 10, 20 years are the munis that I'm adding over here. I'm not yet buying long-term treasuries, but I'm buying longer-term munis. The shorter-term ones are the firepower in short-term treasuries that I keep. If there is a crash in the long end and long-term yields go sky high, I will allocate a bunch of this to the long term. If there isn't a crash and the stock market crashes, meaning it's called, moving to safety. And if the market moves to safety, meaning if people sell stocks and buy bonds, bond prices will go up, in which case I will have a profit in that area, but stock prices will crash. I will use this firepower to buy stocks. That is my strategy. You do you. I would love to hear how you are thinking, and thank you for watching Yield Nerd.